Good evening. This is Ken Long at Tortoise Capital with a executive summary discussion of market classification for the swing trading home study course. So, a useful market classification, I think, has to have at least the following qualities. It's got to be timely, and by that I mean that when the market condition changes, it happens with enough time that you can still act on the information with the systems that you propose to use. So if it tells you too late after the fact what the market was, it's interesting but not useful. There should be some sense of the probabilities and edges and opportunities that are available inside the different categories of your market classification. So it should tell us about what we can expect and how those expectations how they change based on the market type. And that should also give us characteristics of that market so we know if some systems ought to be favored rather than others. Now we can back test that and brute force test it, but if we have a deep understanding of our systems and the kinds of edges that they give us, we should be able to relate that somehow to the market classification strategy that we're using. The system should be sensitive but not too sensitive in that there's enough of a buffer so that we are not rapidly changing market types or too rapidly to be able to act on them. So you're looking to try to tune that, I think, somehow to the related to the length of the trade you're proposing to take. If you are swing trading and your typical trade is 5 days and your system for classifying the market makes 20 different state changes in those 5 days, it's probably overly sensitive when it comes to trying to manage your particular system. And so related to that is this idea that the classification should be related to your typical holding period. So in my longest term market classification strategy, I'm looking back 6 months and using the statistics of the market over the last 6 months to define today's market type among one of 9 categories. You can read that in the info paper I've provided. That one changes maybe every couple weeks, and there's sort of an organized pattern as it goes from category to category in a logical manner, and that's pretty well suited for swing trading because I hope to be able to hold those trades for 5 to 10 days. And so it seems to be well suited to the swing trade. It's not as useful for day trading, for example, because the intraday moves can be large in either direction regardless of market type, and so the market classification strategy I use for swing trading is not nearly sensitive enough for what I need for the intraday market. And so I should say also something about the sufficient number of distinct categories. And by that, what I mean is that you want to have enough distinctions that the difference makes a difference, but not so many that it becomes unusable. And I found in the categories that I use with the bull, sideways, and bear, volatile, normal, and quiet, I have a sufficient degree of distinction and a reasonable enough set of categories, and there are statistically significant performance expectations that vary by the square that you're in. So I feel like that does a pretty nice job of setting this up for swing trade market classification. Now, when I say market classification, there could be a number of different interpretations, but here's how I use it. Since I'm trading mostly large cap stocks or large broad indexes that are strong related to the S&P 500, I use the S&P 500 as the market. The strong correlations between the market and the sectors and the large cap stocks are useful because they're so strongly correlated that if I get the market call right, then I'm about 50% right on the sectors and individual stocks. However, you could also say that each symbol is its own market, and if you think about it in terms of seasonality, you might use descriptors of the characteristics of the symbol's performance against its larger market behavior, and in that sense you could actually think about market classification being a rich description of just the symbol or even the sector that it's in. All right, so what I want to do now is run through the daily and weekly report and show just where I believe I'm getting my edge when it comes to making market calls. Robert likes to call this the market mosaic, and then we'll see why. That each of these represents one piece of the pie, and when you add these all up, I think you get a holistic view of the market that's greater than the sum of the parts. So let's take a look at this right now. So these are all strategies that I have for, or indicators that I use to get a read on the S&P, and in some cases also on the targets of interest. So I've organized these according to what I consider to be the priorities of importance in the swing trade category. Some of these I use for day trading as well, but I really just want to look at the priorities for swing trading. And then in the page column, what you'll see is where the information is contained in the Tortoise Daily Report. If it says D, the Market Health Check is a separate file that I send out, an image file that accompanies the daily report, but is not a page in that daily report. And these that are indicated as a W are ones that appear once a week on the weekend report, and they tend to be summaries of the longer term trends, such as what are the holdings of the blended monthly rebalancing, the ETF2 swing system allocations, and then the world market model and the various extracts of that model we have for sectors and components and countries and regions. So that's how you read this. Otherwise, if there's a number in there, it corresponds to a particular page inside the daily report. And so for me, for swing trading, the most important classification strategy or symbol for me is on page 2, and that's the risk Z. And this one represents the relationship between the 30-period moving average and the 10-period moving average of the VIX. And in normal volatility, you will see that the 10 is lower than 30. And that means in a normally uptrending market, volatility is decreasing, and so the 30-period moving average is going to be larger than the 10. So anytime that 30 divided by the 10 is greater than 1, then we have a normal condition where volatility is draining. And then when we have volatility spikes in the S&P, the 10-period moving average will get bigger faster. And so so the 30 divided by a larger number will give you something less than 1, and that tells you that we're into risk-off conditions. And so we compute that every day, and then find the z-score of that number, and we're comparing each day's volatility index, which is the 30 divided by the 10, and looking back 20 years in order to compute these different z-scores. We then plot the z-scores on the histogram, and anytime it's less than 1, less than 0, then it's going to be red, and it acts just sort of like a MACD histogram, but for volatility, and it's using a 20-year look-back period. And what we found is that, and I'll cover in a later lecture, that there are some opportunities that when we get into the spring season, that is, it's gone more than 1 standard deviation down and it's starting to hook back up, we're entering the zone for being able to manage some very nice swing trades on the long side. It finds turning points in the market as defined by volatility statistics, and so it's an application we put together based on some academic research. I haven't seen anybody else do this, and so I really think it supports swing trading, gives us insights about where the market is turning. On the upside, it also tells us if it is abnormally quiet, in which case we really want to make sure that we've got our stops in place in case of sudden market shocks that might give back too much of our profits. So the risk Z is an important way to characterize the swingability, if you will, or the volatility conditions inside the market, and I basically am looking at the shape of the histogram and the z-score in order to inform my decision making. So each one of this is about 90 days worth of look back, and you can see just how smooth that is, and that's why it gives us a nice reasonably adaptive but smoothly performing indicator for a volatility classification of the market. The next one for me is the RLCO framework, and that's just really, it's any chart. If it's an asterisk, it's not in a chart per se. But the RLCO framework gives me, I think, like a universal lens for being able to evaluate reward to risk ratios in all time frames, and identifies turning points that are statistically significant. And so it's, at a glance, I'm able to get a health check on the market by using that framework. So that's my next go-to thing. The slope stat, or the slope statistic of the 30-period regression line of the S&P 500, is something we find on page 7. So I want to cover that right now. This one's important to me because what you can see is how smooth that slope statistic is. So we compute the 30-period regression line every day and find the slope of that line, and then plot the time series of that slope, and then compare that time series and that daily number to the last 6 months, and compute statistics on it and find out where in the z-score that it is. And when we plot it on this chart, the thin black line is a 10-period moving average of that line, so it acts as a smoothed early warning or a tripwire. And so anytime we get a crossover of the slope stat and its 10-period moving average at a distance more than one standard deviation from the long-term average, then that tells us something, that a potential turning point on a swing basis has just occurred. And so the market would definitely be negative while this is falling, but when it crosses over its 10, this is the sweet spot for the stealth trade when it has started to reverse. And you can see that on performance relative to the 200-period moving average, that when this turning point occurred, there was a nice move afterwards. When it rolls over on the top side, more than 2 standard deviations above the long-term average, which is this black line, that tells us that that run just may be done. And then look at the difference in performance during the run up and the run down, and then this big sell-off here. We got plenty of early warning using the slope statistic. So that, to me, is a very nice way to see where in the seasonal life cycle of yin and yang that market really is. The gap stat is a way to measure the volatility of the daily gaps. When it's small, then there has been hardly any overnight surprises. When it's large, there have been some, and so this relative size of the gap stat, which we can find back here on page 4. So I'm looking for the S&P's gap stat here by looking. There's the S&P, and so the gap stat is right at 1.67. I'm sorry, 1.47. So it's $1.47. So it's about a 1% gap statistic, and that tells us if the day ahead is likely to be large range or small range as a function of the size of the gap. And so that tells us something about how shocking the overnight trade has been, how much gap activity there has been. Market classification strategy, that's that 9-box indicator, which is the very first thing in the upper left-hand corner is I look at. Right now we're in bear volatile, so that matters, and you have an info paper on how I compute all that stuff and what it means and how to interpret it. Continuations for me really are more about the symbols and the targets themselves than necessarily the S&P. But what I like to look for are decisive moves on day 0, and then a follow-through on day 1, either in the direction of or a continuation of the previous day's big move, or as a rejection of that and then a reversion back to the mean. So the continuation play of momentum after extraordinary days, to me, is a market that is ripe for large moves and to get swing trades well started. The market health check comes out daily in addition to the daily report, and it is a graphic measure or summary of statistics and indicators. This is what that looks like. I narrate this every weekend, so listen to some of those for details of how I do it. But basically, this is a frame of reference that is moderated by these different geometries. So the vertical blue lines are 10, 20, and 30 days worth of look back. The purple lines are identified resistance levels that are now price targets. The red lines are support levels. The slope of the 30-period regression line is the sine wave looking line right here. The extremes are marked off by greens and reds. This index on the left-hand side tells us how steep that slope is at a particular moment. Anything more than 0.4 or less than minus 0.22 turns out to be an extraordinary move, because that's the statistical range of the average over time. That's the average plus or minus 1 standard deviation. I use the 10-period and 30-period RAF regression channels to help classify where the price is inside the normal trend. I use the I care about this distance that it is sold off from the previous swing high. Right now it's over 11%, so this is really bear territory. You can see that we're below the 200-period moving average, which is this red line, and why it's shaded red. You can see the RLCO framework in the background with the Bollinger Bands, the river, and the floodplain. And so price location inside this RLCO framework comes to me, but also some of these structured time periods and indicators like percent price oscillator and Williams percent R give me a sense of overbought, oversold, and when those intermediate term trends can change. So this is a very useful integrating document for me. It gives me my first read on where we are, and so this is the first thing that I update every day when the market closes in order to get my market context right. So that's what I mean by the health check. The auto framer on page 6 really is a way to describe price with respect to market condition. It tells you, is price at a tradable moment given the normal structure of the market? Can I auto frame a trade simply on the basis of trade location? And if I can, that tells me something about what kind of market this is. And it's just made an extraordinary move, and it has allowed me a favorable reward to risk ratio just on the basis of trade location and no other criteria. So it's a relaxed way to swing. And you can see the mechanical framing numbers contained here. The next one, swing trade signals and the RSI2. These are all on page 4. It's also page 3 for the Dow, but page 4 for the S&P. So I'll just show that. So I like having all of my swing trade signal generators in one spot, along with the auto framer reward to risk ratio and the max pain range compression. That gives me a glance at what's working in the market, and since these are all relatively highly correlated, it gives me a chance to see whether or not the symbols are firing because of market conditions and they're tagging along, or if there is true differentiation between individual symbols and the market itself. The fact that only 4 of them are down right now for 5 days down tells me that these are probably legit signals, and it's not as part of a market classification problem that there's a lot of signals. So if I see a lot of signals in one column, it tells me it's really the market itself is in that kind of condition and it's playing the tune. If I see only a couple, they become interesting on an individual basis. So I look at the RS2 as a way to describe the last 2 days when that thing is oversold, like most of them are right here now in the single digits. When that's below 10, then there's a good chance that this is a short-term overreaction and a washout kind of sale, and so there may be a chance for a value play. I'm going to fast forward down to the 10-day NDX and the price change. These two sets of indicators over on the right-hand side of the daily tell me how each of these has performed against the broad market peers that are members of each page. When they're highlighted red or green, it means they are more than one standard deviation away from the population mean, so these really are extremes. And you can tell right now that XIV has been horrible over every time period we look back, from 1 day to 10 days to 1 month, 3 months, 6 months, and 12 months. And then the NDX tells me where inside a calibrated scale of 0 to 100 price is currently located. So that gives me a sense of trade location inside that market range, which I take as a form of market classification. Next up would be the regression lines of the S&P on page 15. So I look at this little indicator here and say, let me take the z-scores of the slopes of these regression lines, the 10, 30, and 90. It's sort of like the slope stat, only it extends it out now to the 10 and the 90. And this gives me different time frames to see where these market participants that are defined by the 10, 30, and 90 are seeing the market. What's sort of their psychology? Anytime it's out of this z-score plus or minus 1, it's sort of an abnormal. Right now the 30 has made a turn after an abnormally large move away from the 0 line there, and the 90 has come out of the river. So this is what that looks like, price with respect to the river. This is also another form of market classification for me. I can see where price is with respect to the river. This is a very simplified version of the RLCO framework in that sense. So I get to see what I think are turning points, and whether we're early or late in the different impulses that move the market in these systematic ways. The next one, X-day holding numbers. That's this one. This tells you, like in the S&P in the first column, for 5 days, 10 days, 20 days, and 40 days, how long, or for each one of those holding periods over the last 5 years, what has been the greatest 5-day performance in the S&P? It was 33.93%. The worst performing 5-day period was minus 37. Today's performance, it's down 9.4%. That is a z-score of minus 1.52, meaning that the losses over the last 5 days are 1.5 standard deviations to the negative. And so this has actually been an extraordinary sell-off over the last 5 days. And then over the last 10, 20, and 40 days, we get those kinds of insights. So this sort of tells you where inside the historical context the most recent performance can be found. Next up is these next three: the blended monthly rebalancing holdings, allocations, and rankings, the ETF2 weekly swings trade system allocations, and then the asset allocation model, and then the summary stats on the world market model, and the different subsets of that we track. All of these come from the weekend report, and they help me see where the winners, the losers, the leaders, and the laggards, which ones are in interesting positions with respect to the broader market. And I take those not only as signals and symbols to trade in those systems, but also for the information value that they provide me about building my total view of what's going on in the market. We've looked at the next two, the NDX and the price change numbers. The S&P volatility statistic on page 13 looks like this. This looks at, for the S&P's holding of the last 40, 20, 10, 5, and 1 days. This, again, tells you the maximum, the minimum, the current. This is basically that holding period, but just for the S&P. And it gives on this stem plot over here an idea of what the normal volatility range is, and notice just how fat the tails are. This is in terms of standard deviations, this is in terms of percentages. And so it gives you a sense that just how quickly the volatility conditions in the market are. And then it also gives you where in the volatility statistic the current reading happens to be. So this is a way to appreciate the complexity and the classification of market volatility. Signal to noise ratio and price change numbers. Again, these are both coming off that page 4. Signal to noise ratio is a way to describe on a scale between 0 and 1, on average, the last 30 days, have there been large bodies or large tails? And so if we see a number like for the S&P, let's find his numbers, 0.41, what that tells you is that only 40% of the average daily range has been real body, that 60% has been in the tails. So it tells you that there's been a lot of backing and filling in intraday volatility over the last 30 days. So that's one where it tells you on an intraday basis, if you're doing a turbo, how trending intraday it has been. It's of interest during swing trades, because if you find something that has large signal to noise ratio, what that's saying is that it has probably been more directional than choppy in terms of the last 30 days. So that gives a little bit of insights there. The next couple, SQN reports, AlphaStat, price change. These are all indicators that look at longer term time frames and relative strength, and come from the ETF2 database and some other proprietary indicators. These tend to be not as useful as some of these other ones, but they are ways to generate ideas for longer term trading rather than maybe the short 2 or 3 day swing. These might be more like swing trades that grow to become position trades. So I'm not going to cover too much about that. The RLFF, the regression line fractal framework, I'm going to say more about that. That has to do with describing fair market value for long-term holders and short-term traders, and measuring the difference between their opinions by using ATR percentage. And so we define long-term holding fair value as the 270 period regression line, regardless of the chart frame. The longer, if you're trading it on a certain time frame, say 5 minute candles, the 270 period, times 5 minutes, so about the 1200 minutes would be the longer term holders. We would consider that to be the long-term fair value. The 10-period regression line on any time frame we take to be the smooth price. And so that's what the short-term traders are. The short-term traders are trading the current price action. The long-term holders are trading value. So the value changes, the perception of value changes much more quickly or much more slowly than price. So traders tend to move price away from the last consensus price as they try to generate some heat and light. So they have a certain amount of money and a certain amount of capacity to move price in the short term. So when the 10-period regression line has moved a large distance away from the 270-period regression line, we might treat that as a case where the short-term traders have a difference of opinion than the long-term traders, and this is the extreme to which they could move price away from that long-term fair value. When it can't go any further, it starts to revert. We can then express the distance between the RL10 and the RL270 as a function of ATR percentages, and that gives us a way to calibrate the size of the reward to risk opportunity ratio that is now developed. Well, that is a way to describe the condition of the market as it's a market in which the long-term holders have a significantly different belief in fair value as compared to the short-term traders. That discontinuity, that divergence, is what sets up the reversion to the mean trade as traders get exhausted and price reverts back to the mean, whether that's up or down. So that's what we mean by the regression line fractal framework. I'll have more to say about that. Finally, another one on swing z-scores. This is also related to that holding period statistic. These are all the numbers of standard deviations away from the long-term average of each of these typical holding periods. So the S&P right now is 1.5 sigma underperforming its long-term 40-day holding average. So if you go back 20 years and say, for every 40-day period in the S&P, what did it return? And then compute all of those 40-day holding periods. Find the maximum, the minimum, the average, the standard deviation. You can then compute these sigmas and then determine if we are within a normal range of performance for the holding period or if it's abnormally good or abnormally bad. If I'm long in a position and I am abnormally good on returns, I will have a standard deviation greater than 1. In this case, gold. Gold has performed to 1.4 standard deviations above its long-term 40-day holding average. That tells me that gold is on a tear, and the fact that it's green in the 5, the 10, the 20, the 40 says that this is a raging good trend that that gold has been on. The fact that it's all more than 1 tells me I got to make sure that I am managing my trades, that I'm not going to give two back of this exceptionally good move. It's been exceptional on every time frame. By the same token, XLV, XLY, IWM, and the Qs are all reds across the board, so they're suffering relatively more than the S&P, which is only red for 40 but is yellow on 5, 10, and 20. So on a relative basis, what you can see is that the Qs, the small caps, are all suffering relatively more than the broader market itself. And so this is a form of market classification for these different large cap companies and these sectors, and that's a way to describe in detail the current condition of the market and the sectors and the stocks that inhabit those sectors and market. Finally, the last, actually not finally, but high day, low day is really more something I look at for triggers on intraday trades, although on a swing trade, these are usually marked off as the universal trade entry and initial stop, both on the long side and the short side. So knowing where those triggers are, I suppose you might think of that as market classification. It's really more of a tool, and I think more useful intraday in terms of setting up trades, whereas on the swing trade it really only signals the entry or exit prices that we care about. And then finally, just the last one, that's correlation z-score on page 23. What this measures is the degree to which each of these broad market indexes are correlated to the S&P. If they were perfectly correlated, then the correlation coefficient would be 1.0 consistently, and there would be no deviation between them and the market, and so that would be the zero line. So these are all the slope statistics, the correlation coefficients, of each of the indexes compared to the S&P, and then when a symbol is tightly correlated to the S&P, then there's not much divergence. It's it would be very close to that zero line, which is the market. Right now, this orange one, which looks like Asia less Japan, is abnormally strongly correlated because it's correlated at the 1.5 standard deviation. So it is performing much more like the S&P than it usually does, whereas these down here in dark blue, this looks like Russell small caps, that is performing just like the S&P, so it's strongly correlated. So what this measures now is I take the difference between the strongest and the least correlated, and when the market is going up, typically the correlations between these indexes will start to differ broadly from the S&P because money is chasing a sector that's outperforming the S&P, and the more money that moves away from the market and towards the sector will cause a difference in performance, which will reduce the correlation coefficient, and then we track that daily number of the correlation coefficients to see how unusual is it for this sector to be behaving differently from the S&P. So in bull markets, you will see a wide spread between the most and the least correlated. In falling markets, the correlation coefficients all go towards 1.0 because everything starts going down together. So this is a way to consider how nervous the market participants are with respect to looking for uncorrelated assets to take advantage of. In normal sector cycling in bull markets and quiet bear or sideways markets, money cycles from sector to sector on a regular basis. And so things move in and out of phase with the S&P. But when selling occurs in such a way that the whole world goes down together, all these differing correlations disappear and everything correlates to 0.99 level of comparison to the S&P. So things differentiate on the way up and then they all collapse together on the way down. And the space in between is sector cycling where they go in and out of phase. So this sort of is a way, this indicator is a way to describe the degree to which markets are unanimous about the direction of momentum and to what extent is money chasing diverging indexes in order to gain a little bit of alpha. So that's the correlation z-score. So in a sense what I want to say is that all of these elements and indicators provide some insights into the market, its condition, the probabilities of moves. It helps me understand what the size of those moves might be. In some cases, they're actionable information about when to get in or get out. In some cases, these are signals for systems which also provide an information content. But all of these really go into making up the market mosaic. And you can see my personal ranking of which ones I think are the most interesting or the most important or the most useful, and you can see how I go down that list and then where these are available. Now, most if not all of these have write-ups on each of the individual report pages so you can see how I use it, how I define them, how to read the scales, and you can tailor some of these things to your own needs based on the kinds of things you want to trade or the opportunities you're looking for. There's ways in which you can selectively pick and choose. So I would become familiar with all of them and then see which ones resonate with you and then become expert in the use of those indicators. So that's Ken Long from Tortoise Capital with the executive summary of market classification. Please read the info paper on the 9-box market classification scheme. That is sort of central to my view of what the market is currently doing, and that's why I put it on page 1, upper left-hand corner of the daily, or actually page 2, excuse me. Page 1 is the index. That's the first thing that I look at to see where we are, and then I come over to look at the 10-day NDX, and then proceed over to look at the market mosaics and the risk Z. This is really, for me, about 80% of the battle of getting the big calls right for the S&P 500. I feel like if I get that right, the rest of it should fall into line. So that's all I have to say on this one. Take good care, and we will see you in the chat room.